Okay, I didn't have Caterpillar becoming an AI proxy stock on my bingo card this year, but here we go. Welcome to Earnings Unscripted. I mean, the numbers today are just wild. It's August 4th, 2026, and we're looking at Caterpillar's second quarter, ticker CAT.
Yeah, the whole pick and shovel narrative is getting very literal right now.
Very. I mean, they just smashed through a century-old ceiling. Revenue crossed $20 billion for the first time, up 24% year over year, which for heavy machinery, that's just a blistering pace.
It's a staggering print. Honestly, top line, bottom line, everything looks elevated. Adjusted EPS landed comfortably above expectations at $8.17 a share, and their free cash flow, it expanded massively from last quarter.
Right. Operating margins looked great too, and the tape initially loved it. The stock gapped up hard pre-market, though, and sorry, here's the interesting part. It faded pretty sharply through the regular session to end in the red.
Well, the market always shoots first on the headline beat, right? Then they ask questions when the real fundamentals show up. And since we're about to dissect those exact fundamentals, it's a good moment to flag that everything we discuss is strictly our own analytical opinion. So please don't base any portfolio moves purely on our podcast logic.
Definitely not. But what triggered that fade, actually? Because, I mean, if you just read the summary, both the power and construction units grew heavily, and they raised full-year top-line guidance. Why wouldn't traders just hold that morning gap?
It's the underlying mechanics. When you see total order backlog swell to $72 billion, your brain assumes it's all pure unstoppable demand. And sure, that momentum's driven by these enormous data centers locking up prime power generation, effectively booking Cat's factory capacity to the end of the decade.
Right. They're practically acting as a private utility for the tech sector now. That's a phenomenal narrative.
It's a great story, yeah, but the margins are where the friction hides. If you strip out a massive one-time legal win regarding international tariffs, the core profitability isn't nearly as flawless as that EPS beat suggests.
Wait, so you're telling me this whole record-breaking quarter's actually leaning on a lucky courtroom verdict? I need to understand how a Supreme Court ruling artificially propped up their margins.
Right. So there was a recent Supreme Court ruling around certain International Emergency Economic Power Act tariffs. Basically, Caterpillar realized they were owed refund, and they booked almost $400 million of that expected recovery directly into this quarter's operating profit.
Wait, so a one-time refund from the government just gets dumped straight into the operating margin? Doesn't that usually sit below the line in some weird tax or other income bucket?
Normally, yeah. But because tariffs initially act as period manufacturing costs, the recovery technically reduces those direct costs. So it effectively pumped their adjusted operating margin by nearly 200 basis points. Without it, their margin would have sat closer to the low 20s range, masking the fact that underlying production costs run pretty hot right now.
Okay, I see where this goes. So that margin expansion we flagged earlier carries a massive asterisk. What happens next quarter when there's no court victory to bail them out?
That's exactly why the stock faded. Next quarter, they don't have that shield, and they face roughly $600 million in expected ongoing tariff hits for Q3. And if you expand that out, they carry it becomes a multi-billion-dollar tariff burden for the full year. So the profitability picture gets a lot messier in the second half.
Well, no wonder Wall Street sold the rip. But you still have to square that messy margin story with this insatiable demand from data centers. If their backlog's functionally booked for the next 3 years, don't they need a ton of new factory capacity to clear it?
I find their capital discipline here fascinating. Instead of going out and dropping billions on a shiny new gigafactory, they just dusted off a discontinued marine engine line.
Wait, marine engines, like for ships?
Exactly. It's called their mock business. They basically took this inactive, heavy marine technology and retrofitted it into 10-megawatt generators for terrestrial server farms. They're bringing over a gigawatt of capacity online, essentially for free, purely by scraping the rust off an old product family.
That's brilliant. It's the ultimate upcycling. They just transformed a discontinued
boat engine into the backbone of generative AI.
Exactly. And the demand constraints strictly outputted this point. Kyle Epley basically spelled it out on the call. No one is slowing down at the moment. In fact, if we can get more units out, they're asking us to give them more units. They even gutted an old bulldozer bucket workshop in Kansas in under a year just to shove more generator manufacturing onto the floor.
That's a beautiful example of sticking to their capital return model instead of getting greedy with CapEx. But if end-user demand stays that ferocious, why are construction dealers suddenly hoarding equipment? Because dealer inventory jumped noticeably this quarter, which breaks their usual seasonal pacing.
They're building fleet right now in anticipation of really strong end-user sales coming up. Management actually flagged they expect an outsized drawdown of over $1 billion in dealer inventory during the fourth quarter.
Okay, but if that retail demand doesn't, actually materialize, that stockpile just becomes channel stuffing really fast. You're suddenly sitting on a bunch of parked excavators.
Right. That's the inventory cliff everyone's trying to model. Will the actual sales clear that bloat out, or does it become a liability entering next year?
Although, if you look at their finance arm, customers seem surprisingly healthy. I noticed Cat Financial's past due rate just dropped to its lowest level since 1998.
Yeah, sitting around 1.3%. It's pristine credit quality. That really de-risks the whole inventory concern because commercial operators clearly aren't struggling to pay bills. And management seems to agree since they just raised their full-year sales outlook to mid to high teens growth.
Which is kind of wild for a century-old metal bender. They're essentially drafting off the tech boom while trying to dodge a multi-billion-dollar tariff wave.
Exactly. The second half is, it's going to be a fascinating stress test. They've got roughly $600 million in tariff costs hitting next quarter alone, and they won't have that courtroom victory to mask the margin compression.
But they're generating so much cash. It almost doesn't matter, right? Did they update the free cash flow guide?
They did. They expect the machinery and energy free cash flow to land somewhere in the top half of their $6 to $15 billion target range.
That's a staggering cushion to fall back on. So we basically have a company pulling discontinued marine engines out of retirement to feed server farms, all while battling trade taxes.
It's just a standard day in heavy manufacturing.
I love it. Well, that wraps us up for this one. It's going to be a really fun second half of the year for Caterpillar. Thanks for hanging out with us, Miro, and thanks to everyone listening.
Always a pleasure. See you next time.
If you're finding these breakdowns helpful, consider keeping us in your usual podcast lineup. And just for full transparency, this entire episode, our voices included, is completely AI generated, digesting those massive industrial filings into a same-day listen. Drop your feedback or whatever Tigger you're watching next to earningsunscripted@datamadness.ca or find the X link in the show notes.
Catch you later.